The sun is setting over Washington, D.C., but the eyes of the financial world are already fixed on the other side of the planet. We are counting down the hours to one of the most anticipated market opens in recent history. The Shanghai Gold Exchange has been closed for the Lunar New Year. For days, the massive Chinese market has been offline. They have been unable to trade. They have been unable to react to the tariff news. They have been unable to react to the explosion in gold prices. But in less than 24 hours, the doors open. And the rumors swirling around what will happen next are sending shockwaves through the trading desks in London and New York. As we speak, silver is trading at $86.77. It is up over 2% on the day. It has erased the slam attempt from earlier in the session. But the price you see on your screen might be irrelevant. It might be a legacy price, because unverified reports are beginning to circulate from the physical markets in China that suggest the real price has already detached completely from the global spot price. We need to discuss the rongtong rumor. Rongtong Gold is one of the largest precious metals recyclers in China. They deal in scrap, they deal in used electronics, they deal in industrial waste. Usually, scrap silver trades at a discount to the spot price. If spot is $86, you expect scrap to be $82 or $83. That is how the business works. You buy cheap, refine it, and sell it spot. However, market chatter surfacing on social media and trading forums today suggests that Rongtong Gold may be offering bid prices as high as $96 per ounce for scrap silver. We must be very clear. This data is currently unverified. We have not seen the official tender documents. We cannot confirm this transaction price with certainty. But as analysts, we have to ask the question, why would a recycler pay a $10 premium over the global spot price for trash metal? Why would they pay $96 for scrap when they could theoretically buy 1,000-ounce bars on the COMEX for $86? There is only one logical answer, because the $86 silver on the COMEX is not available to them. Or they believe that when the Shanghai Exchange opens tomorrow, the price is going to gap up instantly to over $100. If these reports are even partially true, it signals a massive arbitrage opportunity. It signals that physical silver in China is in a state of acute shortage. It suggests that industrial users are panic buying raw material before the tariffs hit. Remember, President Trump has just raised global tariffs to 15%. If you are a Chinese solar panel manufacturer or an electronics giant, you know that your costs are about to skyrocket. You know that the currency war is escalating. So what do? You secure your inventory. You buy every ounce of silver you can find, at any price, to keep your factory running. You don't care if the chart says $86. If the only metal available is $96, you pay $96. This is how hyperinflationary events begin. They don't start on the futures exchange. They start in the supply chain. They start when a recycler pays more for scrap than a banker pays for a contract. This is the backdrop for the Shanghai reopen. The arbitrage gap is already wide. The Shanghai premium, the difference between Chinese and US prices, has been persistently high for months. But if the scrap market is trading at $96, we could see the Shanghai Gold Exchange open tomorrow and immediately limit up. We could see a violent repricing that drags the rest of the world higher. The Western paper speculators are terrified of this. You can see it in the price action today. They tried to slam the price down this morning. They tried to use the volatility in the stock market to trigger a liquidation in metals. But every time silver dipped, it was bought. It refused to stay down. It climbed back above $86. It climbed back above $87. The market smells the fear. The market knows that if Shanghai opens at $100, anyone holding a short position in New York at $87 is instantly insolvent. And look at gold. Gold is trading at $5,211. It is up over $100 on the day. It has cleared the $5,200 level, which many technicians viewed as the final resistance before the all-time highs. Gold is sniffing out the same problem. It is sniffing out the devaluation of the dollar relative to hard assets. But silver is the one with the explosive potential. Gold is a monetary asset. Silver is a strategic, industrial, and monetary asset. And right now, it is the industrial side that is panicking. The rumor of the $96 scrap bid is a signal of industrial desperation. It is a signal that the physical float is gone. In the next part of this deep dive, we are going to pivot to the United States. We are going to look at why the U.S. stock market is crashing. The Dow Jones is down 600 points. We are seeing volatility metrics that rival the 2008 financial crisis. We need to understand why capital is fleeing the greatest economy on earth and flooding into the barbarous relic of precious metals. We will analyze President Trump's latest tweets regarding the Supreme Court and the EU. We will explain why trade war volatility is the ultimate fuel for a silver squeeze. Because while China is paying a premium for metal, the United States is creating the uncertainty that makes that metal necessary. Stay focused. The East is about to wake up. And the West is about to realize that the price of silver is no longer set in New York. While the East is scrambling for physical metal, the West is watching its financial system fracture in real time. We have to turn our eyes away from the Shanghai arbitrage for a moment and look directly at the chaos unfolding on Wall Street. Because what is happening in the United States equity markets today is the fuel that is driving the silver rocket. You cannot have a super spike in precious metals without a catalyst. And today, we received that catalyst in the form of a 600-point collapse in the Dow Jones Industrial Average. The headlines will tell you it is just a red day. They will tell you it is profit-taking. But if you look under the hood, if you look at the structural data coming from institutional desks, you will see that this is not a correction. This is a panic. We need to start with the source of the volatility. We need to look at the feed coming from the White House. President Trump has taken to social media in a way that has rattled the very foundations of global trade. Following the Supreme Court's decision regarding tariffs, the president has interpreted the ruling as a blank check. In a series of posts that can only be described as aggressive, Trump stated that the Supreme Court has reaffirmed that he does not need Congress to approve his tariffs. This is a massive shift in the balance of power. For decades, markets relied on the idea of checks and balances. They relied on the idea that Congress would stop a president from starting a global trade war. But today, that safety net is gone. The president explicitly tweeted, "Any country that wants to play games with the ridiculous Supreme Court decision will be met with a much higher tariff." He is threatening much higher tariffs and worse to the European Union. He is responding to the EU's proposal to freeze the ratification of its trade agreement with the US. Think about the implications of this. We are not just talking about a 15% tax on Chinese steel anymore. We are talking about a potential freeze of trade with Europe. We are talking about the disruption of the entire transatlantic economy. This is why the Dow Jones fell 600 points in 30 minutes. The algorithms that price in corporate earnings looked at these tweets and realized one thing: the supply chains are broken. If you are a company like Apple or Ford or Caterpillar, you rely on the free flow of goods across the Atlantic and the Pacific. If that flow stops, or if it is taxed at 20% or 30%, your profit margins evaporate, your earnings per share collapse, and your stock price has to be repriced lower immediately. But the scary part is not the headline number on the Dow. The scary part is the stealth crash happening underneath the surface. We need to analyze the data provided by the Kobeissi letter, because they have highlighted a statistical anomaly that we haven't seen since the great financial crisis of 2008. According to their latest report, the one-month realized volatility of the average stock in the S&P 500 is skyrocketing. It has reached 24 points. This is the highest level on record. And yet, the index itself, the S&P 500 number you see on TV, has been trading in one of the tightest ranges in history. How is this possible? How can individual stocks be crashing while the index looks calm? It is because the generals were holding up the market while the soldiers were being slaughtered. The massive tech companies were keeping the index flat, hiding the carnage in the rest of the market. But today, that dam broke. The volatility of the average stock is now higher than it was during the collapse of Lehman Brothers. This means the market is incredibly fragile. It means the liquidity is thin. It means that when the selling starts, there are no buyers to step in. The Kobeissi letter asks a terrifying question. Is the index volatility set to spike? The VIX, the fear gauge, is trading around 20, but based on the internal damage, it should be at 35. We are sitting on a powder keg of volatility, and historically, when stock market volatility explodes, where does the money go? Does it go to cash? No, because cash is being devalued by the tariffs. Remember, tariffs are inflationary. They raise the price of goods. If you hold cash during a tariff war, you are losing purchasing power every single day. So the money cannot stay in stocks because earnings are crashing. And it cannot go to cash because inflation is rising. There's only one door left open, the door marked hard assets, the door marked gold and silver. This explains why gold exploded over $5,200 today. While the Dow was shedding 600 points, gold added over $100. This is the decoupling we have been waiting for. For years, gold and stocks often move together. Risk on, risk off. But today, we are in a risk-off environment for paper assets and a risk-on environment for real assets. Investors are looking at the chaos in Washington. They are looking at the trade war with Europe. They are looking at the broken supply chains, and they are saying, I don't want to own a company that depends on global trade. I want to own the money that has survived every trade war in history. And then there is silver. Silver acts as a more volatile play on this chaos. It benefits from the monetary flight to safety, just like gold, but it also benefits from the supply chain panic. If trade with Mexico is threatened, and we will get to that rumor in a moment, or if trade with China is shut down, where does the industry get its silver? The stock market crash tells us that the just-in-time delivery system is dead. Companies can no longer rely on getting their materials tomorrow. They have to hoard them today. And this hoarding mentality is spilling over from the industrial boardrooms to the retail investor. The stock market is flashing a warning sign that the system is unstable. And when the system is unstable, you don't want a counterparty. You don't want a stock certificate. You want a bar of metal in your hand. We are witnessing a regime change. We are moving from a regime of low volatility and global trade to a regime of high volatility and economic nationalism. In the first regime, stocks win. In the second regime, commodities win. The 600-point drop in the Dow is the market pricing in this new reality. It is the sound of capital leaving the old world and entering the new one. And in this new world, the price of gold is $5,200. And the price of silver is pushing $87 and looking higher. In the next part of this deep dive, we have to address the elephant in the room. We have to address the most dangerous rumor currently circulating in the geopolitical sphere. The report that China believes President Trump plans to intervene in Mexico to secure silver deposits. We must stress that this is unverified, but we must also analyze why the market is reacting to it. Mexico produces 25% of the world's silver. If that supply is militarized, or if it is cut off from China, then the World War silver scenario becomes a reality. We will connect this rumor to the Shanghai reopen we discussed in part 1. Why is China paying $96 for scrap? Maybe it's not just about tariffs. Maybe they are terrified. They will never see another ounce of Mexican silver again. Stay with us. The economic war is turning into a resource war, and the battlefield is the silver market. We have analyzed the financial arbitrage in Shanghai. We have analyzed the trade war volatility in New York. But now we must step into the shadows of geopolitics. We must address the third and perhaps most explosive pillar of this rally. It is a narrative that is currently whispered in intelligence circles and shouted on social media. It is the reason why some analysts are calling this moment World War Silver. We are talking about the unverified yet market-moving report that the Chinese Communist Party is preparing for a scenario where the United States forcibly secures the silver supply of Mexico. Let us be absolutely clear before we proceed. This is currently a rumor. There is no official declaration of war. There is no confirmed troop movement. However, in the world of high-frequency trading and global strategy, rumors often move prices long before facts are confirmed. And this specific report circulating today alleges that Beijing believes President Trump has plans to intervene in Mexico. The report claims the objective is not just border security or narcotics control, but the securing of strategic mineral deposits. Specifically, the report mentions a staggering figure, $600 billion worth of silver reserves. Why is the market taking this seriously? Why is silver erasing every slam attempt and soaring over $88 on this news? Because geographically and geologically, Mexico is the Saudi Arabia of silver. Mexico is the world's largest producer of silver. It accounts for roughly 25% of global supply. For centuries, the flow of Mexican silver has dictated the global price. But in the 21st century, silver is no longer just money. It is a strategic weapon. It is the essential component in the guidance systems of cruise missiles. It is the conductive heart of the solar panels that power the green energy grid. It is the critical material in the satellites that control global communications. Without silver, the modern military-industrial complex grinds to a halt. Now, look at the geopolitical chessboard through the eyes of Beijing. China is the world's largest consumer of silver. They need it for their massive solar industry. They need it for their electronics manufacturing. They are heavily dependent on imports to keep their factories running. And where does a huge portion of that silver come from? It comes from Latin America. It comes from Mexico. If the United States were to enact a policy, whether through tariffs, sanctions, or direct intervention, that cut off the flow of Mexican silver to China, it would be a catastrophic blow to the Chinese economy. It would be an existential threat to their technological dominance. This brings us back to the rongtong rumor we discussed in part 1. Why is a Chinese recycler paying $96 for scrap metal? Why are they paying a $10 premium over the spot price? If you believe that the supply from Mexico might be cut off next month, then $96 is cheap. If you believe that 25% of the global supply is about to be nationalized by the United States, then you don't care about the price. You care about possession. This is panic buying on a sovereign level. It is the behavior of a nation that fears a resource blockade. And we must look at the rhetoric coming from the Trump administration. While an invasion is an extreme scenario, the concept of resource nationalism is central to the America First doctrine. We have heard repeated statements about critical minerals. We have heard the administration state that reliance on foreign supply chains is a national security risk. Is it a stretch to imagine the U.S. pressuring the Mexican government, currently led by the Sheinbaum administration, to prioritize silver exports to North American partners over Chinese adversaries? No, that is standard geopolitical leverage. In a trade war, you use every asset you have. And Mexico's silver is the ultimate asset. The mere threat of this, the mere possibility that the U.S. could weaponize the Mexican silver supply, is enough to drive the price to $100 and beyond. This creates a risk premium that cannot be calculated by standard chart analysis. Technical analysis can tell you about resistance at $90, but it cannot tell you what happens if the world's two superpowers start fighting over the mines in Zacatecas. This is what we mean by World War Silver. It is the transition of silver from a financial asset to a strategic imperative. In World War II, nations fought over oil fields and steel mills. In the modern economic war, they fight over lithium, cobalt, and silver. And right now, the market is pricing in the risk that the battle for silver has just begun. This rumor also explains the resilience of the price. Traders in New York might want to sell and take profits. But traders in Shanghai are looking at a map. They are looking at the vulnerability of their supply lines across the Pacific. And they are buying every contract, every bar, and every scrap of metal they can find. They are front-running the embargo. This is why the slam failed this morning. You cannot short a market that is driven by existential fear. Short selling works when the price is driven by speculation. It fails when the price is driven by necessity. In the next part of this deep dive, we are going to look at the tangible market mechanics that prove this stress is real. We are going to look at the comex delivery data. We have reports that deliveries rose to 23 million ounces in February. We have March open interest sitting at 223 million ounces just 3 days before first notice day. We are going to explain why this geopolitical panic is colliding with a physical shortage at the worst possible time for the banks. The banks are short paper silver, but the world is demanding physical silver. And if the rumors about Mexico are even 10% true, there's not enough silver in the vaults to cover the panic that is coming. We will also look at the technical setup for gold. Gold has exploded over $5,200. It has cleared the last hurdle. We are now in the final stretch to challenge the all-time highs near $5,600. Gold is the shield. Silver is the sword. And right now, both are being wielded in a conflict that is rapidly escalating beyond just tariffs and taxes. We have discussed the rumors of war in Mexico. We have discussed the arbitrage in Shanghai. But now, we must look at the hard, cold mathematics of the New York futures market. Because while politicians argue on Twitter, the vaults at the comex are being drained of physical metal at a rate that is becoming mathematically unsustainable. We are witnessing a run on the bank in slow motion. And the data we received today regarding the February delivery cycle proves it. Let's look at the numbers. Usually, February is a quiet month for silver deliveries. It is not a major contract month like March or May. But in this chaotic environment, there is no such thing as a quiet month. Total comex silver deliveries for February have risen to 23.475 million ounces. Another 6 delivery notices were issued just this past Friday. Why does this matter? Because 23 million ounces of physical silver were taken out of the system in a non-major month. This tells us that the desperate buyers, the ones paying premiums in Shanghai, are not waiting for the big contract months. They are standing for delivery every single chance they get. They are sweeping the floor. They are taking every bar that isn't nailed down. And now we are staring down the barrel of the March contract. We are exactly 3 trading days away from first notice day. This is the moment of truth. This is when the holders of paper contracts have to decide, do I roll my position to May, or do I demand the metal? The open interest for March remains at a staggering 223 million ounces. Yes, it declined slightly by 3,000 contracts on Friday, but over 44,000 contracts remain open. Do the math, 223 million ounces of paper demands versus roughly 88 million ounces of registered silver in the vault. That is a leverage ratio that would make a gambler sweat. Even if half of those contracts roll to May, the remaining demand is still larger than the available inventory. The banks are trapped. They are trying to convince traders to roll into the May contract, which has now surpassed March with 56,000 contracts. But the traders are hesitant. Why would you roll a contract when you fear a trade war? Why would you accept a paper promise for May when you can demand physical metal in March? The fear of missing out is transforming into the fear of never getting it. And look at the price action in gold. Gold has exploded over $5,200. The chartists are calling this a blue sky breakout. The last major hurdle before the all-time highs near $5,600 has been cleared. Gold is not waiting for the comex to sort out its paperwork. It is repricing the entire global financial system. When gold moves this fast, it acts as a vacuum for silver. It pulls silver higher by sheer gravitational force. Historically, silver lags gold at the start of the move and then slingshots past it at the end. With gold at $5,200, a silver price of $88 is still historically cheap. The ratio is screaming for silver to catch up. But we have to add one more layer of chaos to this fire. We mentioned the trade war with China, but President Trump has just opened a second front. He is now targeting the European Union. In a series of what can only be described as rage tweets, President Trump responded to the EU's proposal to freeze the ratification of its trade agreement with the US. He threatened much higher tariffs, and worse, he stated that the Supreme Court decision has emboldened him to act unilaterally. This is a nightmare scenario for the global economy. A trade war with China is painful. A trade war with China and Europe is catastrophic. It means the entire global trading system is fracturing. It means that the euro, the yuan, and the dollar are all actively being weaponized. This geopolitical instability is the ultimate accelerant for the comex squeeze. If you are a European bank holding a short position in New York, and suddenly your political leaders are in a trade war with the US president, do you feel safe? Do you feel confident that the rules of the game won't change tomorrow? No, you cover. You buy back your short position at any price to get out of the crossfire. This is why the volatility metrics from the kobeissi letter are spiking. The institutions are de-risking. They are selling stocks. They are covering shorts. And they are buying the only asset that has no political allegiance. They are buying gold and silver. So, as we head into the final 3 days before First Notice Day, the setup is perfect. We have a physical shortage, confirmed by the delivery data. We have a massive open interest that refuses to go away. We have a gold price that is breaking out to new highs, and we have a global trade war that is expanding from Beijing to Brussels. The paper silver market is being squeezed between a rock and a hard place. The rock is the physical demand from China. The hard place is the geopolitical chaos from Washington. In the final part of this deep dive, we are going to synthesize all of this into a clear strategy for the next 24 hours. We are going to focus on the Shanghai reopen tonight. We are going to give you the specific price levels to watch. If Shanghai opens and rips higher, does silver break $90 immediately? Does the rongtong $96 rumor become a reality? And what should you do if we see a gap up tomorrow morning? The volatility is dangerous, but the trend is undeniable. We are watching the end of the paper price manipulation and the beginning of true price discovery. This brings us to the end game for today's session. We have covered the rumored $96 bid for scrap silver in China. We have covered the 600-point collapse in the Dow Jones caused by the escalating trade war. We have covered the World War silver narrative involving Mexico's supply. And we have covered the mathematical squeeze tightening on the comex delivery month. Now, as the clock ticks down to the opening bell in Shanghai, we need to synthesize all of this into a clear strategic outlook for the next 24 hours. Because what happens when China wakes up will likely determine the trend for the rest of the year. We are entering a window of extreme price discovery. And in price discovery, old resistance levels mean nothing. The map has changed. Here's the market analysis and the key levels we are watching for the Shanghai reopen. Step 1. Watch the opening price on the Shanghai Gold Exchange, SGE. If the reports about rongtong gold paying $96 for scrap are true, we should see an immediate and violent gap up in the spot price on the SGE. It will likely trade at a massive premium to the London and New York prices. If Shanghai opens trading at the equivalent of $95 or $100, it will act as a vacuum cleaner for global silver. It will force arbitrage traders in the West to buy every available ounce in London to ship it east. This is how the price in New York gets dragged higher. It doesn't happen because American banks want it to. It happens because they are forced to chase the real market in China. Step 2. Watch the stock market contagion. The Dow is down 600 points. The volatility metrics are screaming. We must be realistic. In a liquidity crisis, where margin calls are hitting stock traders, investors sometimes sell everything to raise cash. We saw this in 2008. We saw it in March 2020. So do not be surprised if we see sharp, violent dips in the silver price as desperate funds liquidate assets. However, in an inflationary trade war, those dips are different. They are bear traps. The smart money uses those liquidity events to buy the dip. They know that cash is trash in a tariff war. They know that stocks are dangerous in a recession, so they sell the stock, take the cash, and buy the metal. If silver dips to $85 or $84 on stock market panic, fundamental analysts would view that as a gift, because the industrial demand from China isn't going away just because the Dow is down. Step 3, watch the First Notice Day countdown. We have 3 days left. The banks are running out of time to smash the price. With gold holding above $5,200, the short squeeze potential is at maximum levels. If the price holds above $88 into the close tomorrow, we could see a rush for delivery that breaks the comex system. The open interest is too high. The registered inventory is too low. And the geopolitical fear is too intense. Finally, we have to talk about the psychological level of $100. For decades, triple-digit silver has been the holy grail. It has been the target that everyone talks about but nobody sees. But with scrap trading at $96 in the gray market and gold trading at $5,000 in the spot market, $100 silver is no longer a fantasy. Many analysts view this as a technical possibility based on current supply-demand imbalances. It is the market realizing that you cannot build a 21st century economy with 19th century prices. The Trump tariffs have raised the cost of everything. The Chinese demand has consumed the supply of everything. And the mining industry cannot produce enough to fill the gap. So, what are the key takeaways for physical holders? Number one, do not use leverage. The volatility we are seeing, with the Dow crashing and silver ripping, destroys leveraged traders. One swing in the wrong direction can wipe out your account. This is a market for owners, not gamblers. Number two, ignore the rumors. Watch the price. We discussed the Mexico invasion rumor. We discussed the scrap price rumor. Treat them as smoke. The fire is the price on the chart. If the price is making higher highs, the rumors are likely true. If the price collapses, the rumors were false. Let the market prove it to you. Number three, stay physically diversified. If the COMEX fails, or if trade wars shut down shipping lanes, the paper contract in your brokerage account might be worthless. In a period of the high resource nationalism, physical silver is what matters most. We are watching the end of an era. The era of global cooperation is over. The era of cheap commodities is over. We are entering the era of resource nationalism. And in this era, he who has the gold and the silver makes the rules. The East is waking up. The Shanghai bell is about to ring. The price of silver is about to be set free. Like and subscribe.